Thank you very much. Thank you, Robert, and thank you for the opportunity to come and talk to you today. It's always great to be able to come out and support events like this and have the opportunity to talk to people who are basically at the front line and give you an opportunity to ask me the questions that you'd really like to ask the regulator. I'm particularly pleased to be able to support the Financial Services Expo and its august chairman sitting in the front row. It's early days yet, of course, just under a month, but overall things seem to have gone very much as the market expected. There have been some well-publicised IT glitches, with some firms faring very much worse than others. But there are clearly some back office backlogs and processing delays. But I think the big news for us is that the world has kept turning, and it's really good to hear that firms are basically getting on with it. Some lenders have attracted press comment because of the pretty tough approach that they're applying to affordability checks. I mean, we've all seen the headlines and the questions. Do you eat steak? How much do you spend on dry cleaning? On gym fees? On your milk delivery? On smoking? How often do you have a haircut? Do you gamble regularly? And I think the best headline of all is, could a bikini wax cost you your house? So I thought it might be worthwhile just spending a little time today reminding everyone about what we actually expect, what was the outcomes that we were actually intending to achieve. Because frankly, we wouldn't have expected much, if anything, to change when it comes to lenders' underwriting practices. I'm not sure if that comes as a surprise to people sitting in this room, but actually we're quite surprised that there has been such noise around this, because frankly, things really haven't changed that much. There's been a responsible lending rule in place since mortgage regulation began way back in 2004. And in a speech a full 10 years ago, in May 2004, in the run-up to mortgage regulation, John Tyner, who was the FSE's then chief executive, explained some of the main factors that needed to be taken into account when deciding whether or not a borrower can afford a mortgage. And key amongst this was that you needed to be satisfied that the prospective borrower has sufficient income to meet the monthly instalment due. And he was very clear that gross income on its own is a very poor guide to affordability, as two individuals with the same income could have very different lifestyles and other financial commitments, meaning that a mortgage that's affordable for one individual could be completely unaffordable for the other. And you just can't assume that borrowers spend the same. You need to check. So lenders needed to look at net income, and by that we meant income after tax and deducting other expenses, such as other borrowing, maintenance, and regular calls on available income, not just collecting that information, but using it to assess whether the borrower can afford the mortgage. And nothing has changed since then. We'd expect an underwriter to look at the information about income and outgoings and make a judgment based on that about the borrower's ability to repay the mortgage today just as much as they had to do then. The only difference is that we've added more detail to the rules to ensure that at least a basic level of expenditure is taken into account. And that's because in the run-up to the crisis, what we saw was lenders relax their lending criteria and their underwriting checks, safe in the knowledge that seemingly never-ending house price increases meant that they'd get their money back anyway. So we actually saw people just not even thinking about expenditure, and in fact, not even thinking about income. They're very happy to accept self-certified mortgages. So we wanted to do something about that. And when we first went out to the market with our proposals about this, we were really very prescriptive. So we set out in very great detail precisely what we wanted each underwriter to take into account when it came to their expenditure checks. But we got, I mean, that was a really seriously controversial consultation paper. I don't know if you remember, I'm sure, Robert, you do. We got a lot, there was a lot of noise about it, and we got a lot of pushback because the view was, and we accepted this, customers can and do flex their spending because they prioritise their mortgage payment. It matters to them to keep a roof over their head. So we accepted that, and what we did was we set some standards around the basic minimum expenditure that lenders must take into account, which is the stuff that really borrowers can't flex. It's the stuff that you, as a borrower, have got absolutely no opportunity to flex. You can't flex it, you cannot deprioritise it in order to prioritise your mortgage payment. And there were 3 limbs to that. The first is the committed expenditure, and that's the contractual payments that you absolutely must make, or you're going to be in serious difficulties if you don't. So you'll end up in court, basically. It's the sort of stuff that you've got no option. Every single month, you're contractually obliged to make certain payments, for example, maintenance under a court order, or some contractual debt. So you have to make it. You must take that into account. We then said the second limb was the basic essentials that every person needs in order to be able to live. I mean, it's extraordinary that we have to ask the market to take these things into account, but we did. And these are the things that a borrower absolutely can't do without. So that's food, water, gas, electricity, heating. The absolute bare essentials that you have to take into account. And we also said that lenders can use actual customer declared information, or we allowed them to use model data, such as the data available through the Office of National Statistics, appropriate for that particular household. So they can use model data. They don't actually have to ask for this information. It's up to them. On top of that, we've asked lenders to allow for a basic quality of living costs, and that's expenditure which goes beyond the absolute bare minimum essential, but that it's still difficult for someone to go without or to reduce. And that basic quality of living costs draws on a broad social consensus. It was actually at the time when we discussed this with the lenders, we used Joseph Rowntree. And there's a broad social consensus about basic needs, and that covers things like clothing, household appliances, so having a fridge, having a washing machine, and basic recreation. So there's a general view that everybody should have a holiday. So those are the basics that we have put through into the rules that lenders must, as an absolute minimum, take into account. Beyond that, it's entirely up to the lender what they want to ask the borrower about in terms of their expenditure. I think that we've heard, for example, today somebody was mentioning gym fees. And of course, if a borrower isn't prepared to compromise on the gym fees because they want to have the fabulous house that they're after, then of course the lender's going to take that into account. It's entirely reasonable for the lender to do that, because bottom line is that every borrower must be able to afford to repay the sum of money that they're borrowing. Interestingly, at the time, 10 years ago, John Tyner described this as nothing more than the application of common sense. And the market's reaction to the MMR overall is that it's common sense. So it would be really good to see common sense prevailing in the market, and I'm sure that will happen as the MMR starts to bed in. And when it comes to talking about common sense, I think it's really important for me to take this opportunity to clarify our position where customers come to the end of a current deal and want to switch to another deal. The transitional provisions that we put in place do not require lenders to undertake an affordability assessment on product switches where no additional money is being borrowed. We've heard of cases where borrowers have been refused the option of switching to a fixed rate on affordability grounds, and then they have to remain on the lender's more expensive standard variable rate. That is not what the MMR says. It's disappointing to see this happening because lenders told us they were more likely to use the transitional provisions if we allowed them some flexibility in how they could be applied. So I don't know whether you remember that we stepped back from what we originally proposed because lenders wanted to have flexibility in applying the transitional provisions, and we allowed them that flexibility. In future, it would be really good to see lenders approaching this in the spirit intended and using the transitional provisions to help out those borrowers looking to move home or wanting a better rate, but finding themselves trapped because of tighter lending criteria and stricter affordability checks. Fundamentally, what the MMR is about is that we do not want to stop people who can afford it from getting mortgages. And this applies equally to older consumers. There was a discussion, I don't know whether everyone here was at this morning's session, but there was a discussion about lending into retirement. And we've heard stories that the MMR means that lenders can no longer allow mortgages to go past the age of 75. Sometimes it's 80, sometimes it's 70, sometimes it's 75. We get lots of customer letters about this. Well, while lenders might have their own risk appetites in this area and may have made a decision not to lend into retirement, there is nothing in the MMR that prevents them from lending into retirement, provided that the customer can demonstrate affordability. And there was some speculation this morning about, so why is this happening? Why are people putting in this limit? And frankly, I think that the reason for that is that many of the bigger lenders have a highly automated, very sophisticated system. And what they do is, it's easy for them then to plug in 75. So it's a definite line drawn in the sand. If you're over 75, you go nowhere, don't go any further. That's much easier if you've got a highly automated system than actually having to think and underwrite the case and think about whether, in fact, that borrower can afford the mortgage into retirement. We also had this morning lots of discussion about the fact that there's a movement on the annuities side, and I completely accept and understand how difficult it is to be able to gauge whether a borrower can afford lending into retirement. And I think that there's lots of really helpful discussion happening in the market at the moment. I'm aware that Paul Smee's been discussing this, that there's a real need for some product innovation in the market to bridge that gap between mortgages coming to an end and equity release. So it'd be quite nice to see some innovation and some products appearing that actually help get over this problem for both the regulator and the lender about, so how can we be satisfied that this customer can actually afford the amount that we're lending them? There's also been lots of claims that the MMR is going to stop the market from growing and stop people from being able to obtain mortgages. And so I thought it would also be good this afternoon to take a look at what's actually been happening in the market over the last few years and what the current position is looking like. And I think the good news is, and we were hearing this morning, is that actually things are looking up. A recent Halifax survey revealed that 95% of mortgage intermediaries are confident about the mortgage market and the prospects for their firms. And I was pleased, if not astonished, to see that the MMR was one of the reasons given for that uplift in confidence. And consumer confidence is on the up. You can probably see that there's actually been a really significant increase in how customers are feeling. And I think that's probably because average household spending power is also on the increase. And we're seeing this reflected in strong application figures. So on a cumulative basis, we're seeing the best year to date since 2009. But we still face a number of challenges. I think there's absolutely no doubt that the MMR is a game changer. Its aim is to constrain the sort of growth that past poor lending practices generated. That's the part of the market that we've seen constrained for some time. And the MMR is going to ensure that it stays constrained as the market starts to pick up. I mean, very little has actually changed in the immediate aftermath of the MMR because the changing risk appetite of lenders post-crisis means that the excesses we saw pre-crisis had already largely gone from the market even before the MMR went live. And you can clearly see that in this slide. I'm sorry, this is an incredibly busy slide, and I apologize for that, but it's really quite interesting to look at how things have changed since 2007, particularly when you look at the credit impaired, interest only. And I think one of the really noticeable things from the slide is the clear shift to house purchase business. But as the following slide shows, much of the growth in the mortgage market prior to 2007 came from borrowers remortgaging, and that was often to raise additional money. And that has changed really very significantly. And you can see from this slide that basically whilst house buying has stayed relatively steady, falling house prices, lower SVRs, tightened lending criteria have resulted in a much smaller remortgage market. Basically, the remortgage market has really gone away, and it's particularly noticeable in that slide. In addition, many of the specialist lenders who offered borrowers poor credit, self-certified mortgages to remortgage to consolidate debt are no longer around. And the MMR will, in future, make it difficult for those types of practices to return to the market. And despite the shift to house purchase business since the crisis, and notwithstanding the government schemes, getting onto the housing ladder remains a real challenge for first-time buyers, with a growing gulf between incomes and house prices. And we saw this from the nationwide presentation this morning. Earnings relative to house prices remain really high, and there's a growing gulf. And house prices are growing, and they are expected to continue to grow. However, despite all those challenges, and there are structural challenges in this market, I haven't covered the demographic changes and all the other challenges that we're facing, we recognize that this is a market that still wants and needs to grow, and there are consumers out there who still want and need mortgage finance. And despite the fall in lending since the crisis, the number of lenders in relation to the number of mortgages remains high in relation to the size of the market. So here you have the number of lenders active in the market today. Okay, so you've got the top 6 lenders continuing to count for over 80% of all mortgages written. And then there's all these other lenders in the market. So what are they going to do? There's a real risk that they have to go to the fringes of the market to be able to compete. So we know that there is still a lot of demand for mortgages from customers who can't get a mortgage. Here you see, we saw this morning as well, the mortgage applications and approvals, this growing gulf between the two. Since around May last year, application levels have increased at the same time that approval levels have worsened. And we actually did a quick piece of analysis around this because, we wanted to understand why is this gulf? What on earth is causing the number of declines? And the reason, from all the lenders we spoke to, is that it's either because the borrower fails the affordability checks or they fail the credit check, the credit search. And that's the predominant reason for the number of declines that we're seeing in the market. I think this highlights 2 important things. First of all, lenders tightened their criteria well in advance of the MMR going live. And there's a potentially significant number of customers, new or existing homeowners, who are now unable to obtain mortgages, but still need mortgage finance. So what does this mean for our regulatory approach? Well, we can probably expect firms, particularly the smaller lenders, to look for innovative solutions to encourage growth. This could give rise to firms finding ways to circumvent the MMR requirements, finding a way to lend to the marginally creditworthy by developing impaired credit products and targeting higher risk, more profitable markets, such as bridging and debt consolidation. I think it's important for me to say that that's not to say that such lending is wrong. That's not what we're saying. But it needs to be done responsibly and with the interests of the customers firmly in mind. And given the numbers of customers potentially trapped because of changed criteria, we also need to ensure fair treatment of the existing back book of customers unable to remortgage. I think there's also likely to be a desire for greater efficiencies and economies of scale, resulting in changing distribution strategies. And again, outsourcing and an increase in execution only are not necessarily bad, but the impact on the customer needs to be thought through. We also, and we're always concerned about this, but we also need to be concerned about the increased opportunities for mortgage fraud. We're already seeing changes in the market reflecting these affordability pressures. And I think somebody was mentioning this morning that there is a trend towards longer mortgage terms and higher loan-to-income ratios. And this is really what the governor is interested in. He worries about the fact that there is affordability stretch and a debt overhang in the market. And, you know, I think that there's all sorts of things that the governor could do that are in his armoury. One of the things that he might think about is making high LTI and longer-term mortgages more expensive for firms, so adding to the capital burden on firms that we've seen in LTVs. So somebody said, why hasn't Lloyd's moved on LTVs? Well, the reason they haven't moved on LTVs is because it's really expensive. And I think we need to think about that. I think that we need to take great care that we're thinking about the terms and we're thinking about the LTIs and we're being prudent and sensible, because if we don't do that, I think the governor will act. And as somebody said this morning, I mean, we don't know what he could do, and we do not know what the impact on that might be. So it's actually, I think the Lloyd's move yesterday was a prudent move. I think it was a preemptive strike, potentially, because of what the governor might otherwise do. And of course, we've seen a concern in the market about the gaming of buy-to-let. We heard something about this morning, to get around the more robust checks on the residential side. So in the 2014-15 business plan, we've set out our supervisory commitments for 2014-15, aimed at helping to address all of these risks. So we've got a post-MMR thematic review. That's going to be a priority for us to ensure that the MMR baseline to ensure affordable lending is implemented. We're going to be reviewing how the market has responded, identifying and acting early on any gaming of the new requirements. We've also got a thematic review of the governance of mortgage lending strategies, and that's to review, given all the pressures that we've been thinking about, that's to review the evolving business strategies of particularly the smaller lenders to ensure that they're being developed and managed in the interest of customers and not just driven by business needs, not just simply chasing the money. We've also got a fairness in mortgage contracts discussion paper coming out in the summer. We've seen the current environment driving changes to contractual terms. So we've seen people upping tracker rates, for example, which, though strictly legal, are widely perceived to be unfair. And this paper is aimed at stimulating a discussion about that and trying to be very open, no preconceived ideas about it, but trying to be open with the market about, so what's the impact of those changes that you're making? And we'd really like to foster a shared understanding of what fair looks like and where appropriate, explore proposed solutions. We've also got equity release hybrid work, and that's preemptive discovery work to establish how new products, and that's particularly those products that are filling the interest-only maturity gap, are being sold, whether they're suitable and whether customers really understand the risks. And then we've got the interest-only maturity risk as part of our strategic approach to mitigating this risk. we're going to be conducting a review of the mortgage interest-only maturity strategies of a sample of our non-relationship managed firms, so that's the smaller C3 and C4 firms, to determine whether customers are being treated fairly in line with the FCA guidance published in August last year. Finally, continuing the challenges that we face, we've got the Mortgage Credit Directive. Since I last spoke to Mortgage Expo quite some time ago, the directive has landed, and we have until March 2016 to implement the changes. We've been working closely with a working group made up of lenders and intermediaries on this, which has included Robert, Amy, and the other trade bodies. And I think we're making good progress in achieving a workable approach that causes minimum disruption to the market. But there are some things in the directive that are non-negotiable. So, for example, we know we're going to have to replace the KFI with the European Standardised Information Sheet. We know that financial promotions are going to include a lot of prescribed detail. And we also have to show 2 APRCs, the one we have today, and another based on the worst case scenario of the highest interest rates that have prevailed over the past 20 years. So there are unavoidable changes ahead, and notwithstanding that the directive is on the whole aligned with the MMR. And finally, a brief mention of second charge. Second charge will also be subject to the directive, and so we are now considering what the longer term regime will look like for the second charge market. We're giving careful consideration to the protection that customers need, but we are still waiting for Treasury to consult on the shape that that regime might take. And then there's consumer credit. And consumer credit, consumer lending in general. Although the MMR aims to ensure customers only take out mortgages they can afford, there's a problem of the other debts, second charges, credit cards, unsecured loans that are often the cause of the financial problems. So basically, you can do all your checks today, ensure that the mortgage is affordable, and tomorrow the borrower goes and takes out a second charge loan. They go and take out a third charge loan, a fourth charge loan, and the mortgage implodes because of the burden of debt. This slide shows the scale of consumer lending. The red block is credit cards. And you can see that borrowing for house buying is a really very small slice of the overall market. And now that consumer credit has come within our remit and we regulate all consumer lending, we now have an opportunity in the longer term to review the way consumers use and access credit and consider consumer indebtedness in the round, with a view to developing a joined-up policy approach to credit regulation in the future. So, I mean, the takeaway for me today is how encouraging it was to hear from the intermediary lenders this morning about the way that the MMR has landed, and that it's very much business as usual. I do know that it is difficult for the frontline brokers who are having to deal with the continuation, basically, of the problems of not really knowing whether an application is going to get through or not, because we still have this computer says no, computer says yes problem. I also know that it's actually really difficult for you because different lenders are asking for different things. And I do know that the IT glitches and the back office, back process, backlogs are, you're the people that are having to grapple with that, and you're the customer-facing people that have to deal with it. I think that it's really important for me to say how much we appreciate all the hard work and the adjustment that's gone on to deliver the MMR, and I want to thank you. And I'm very happy to take any questions. Thank you.